Hey everyone, today we are talking about delivery and freight. These are two terms that are very important in accounting. You will see them with almost every company that you do bookkeeping for. Think about a time when you have heard the word freight. Sam, have you ever heard the word freight before?
Nope.
Freight car.
Oh, yes.
What is that?
It's a part of the train.
Part of the train. What do you think it does?
You put stuff in it,
Yep.
and then it moves around with the train.
That's pretty much it. We can end now. Just kidding. So, Sam here runs a factory in Russia. Go ahead, Sam. And this over here is my Sesame Street store. And at my Sesame Street store, we sell erasers. So, as the owner manager of the Sesame Street store, I need to order some erasers, which are merchandise that I am then going to sell to customers. So I go online, make a call to my favorite salesperson at the factory in Russia. I say, hey, I need some erasers. And can you sell them to me?
For the right price.
Okay, there you go. So yes, he can sell them to me, and they need to get from the factory in Russia to my Sesame Street store in Prince George, British Columbia, Canada. How are they going to get here? How do you think they're going to get here?
I'm gonna ship them through trains.
Over the ocean?
In planes?
Sure, let's start with the plane. Bring the plane over. All right, we have a handy dandy freight plane. Gonna open it up. It's gonna be a bunch of erasers. All right, so Sam in the factory in Russia is gonna fly the plane, which is freight, apparently very slowly over to Canada. It lands, and the plane apparently comes right up to the store, opens up, dumps off the cargo, which is our merchandise, the erasers, and leaves. This action is called freight in. Freight in refers to when a company is purchasing from another company merchandise which will be sold to customers. So now we have erasers that are in. So my Sesame Street store purchased erasers from the factory in Russia. How are these all connected? What is happening? Well, the factory in Russia is our accounts payable. This is the company that we are buying from. Therefore, it is an account that we have with this company in order to buy stuff. And so that means it's an accounts payable account. So the Sesame Street company makes an arrangement to order the merchandise. And I haven't paid it yet. Sesame Street hasn't paid it yet. So we're going to owe the factory in Russia. If we owe them something, is that an asset, liability, equity, revenue, or an expense? It's a liability. If we have a loan or we owe someone anything, that is a liability. So we owe the factory in Russia, so it's a credit to accounts payable factory in Russia. Now, the debit, there's a couple pieces there. One of the debits is actually these erasers. Eraser expense, merchandise expense, most commonly called purchases in your textbook, most commonly called purchases in all the bookkeeping that you're going to do. No matter if it's erasers or lumber or Lego or pieces of equipment to build a John Deere tractor. Doesn't matter what it is going to be a debit to purchases expense. However, there is a piece of this expense. There is a part of the money that is owed to the factory in Russia or to the plane company that flew it. And that is referring to the cost of having it transported in. So the cost of having it transported in, that is called the freight. So when we have factory somewhere, a source somewhere, that means that our items are coming from somewhere. So from starts with FR, freight starts with FR. You need to remember that freight in refers to a product coming from somewhere to our store. Freight never refers to something going out of the store. It only refers to items coming into our store. So the cost of that airplane was $1,000 to fly. It was super cheap, all the way from Russia to here. So the freight in cost was $1,000, and we got $100 worth of erasers. So we have 100 debit to purchases, 1,000 debit to freight in. And then the two combined, 1,100, is a credit owed to factory in Russia. And then when I go get my handy dandy checkbook and I pay my $1,100 check and I send it to them, that is going to be a credit from the bank and a debit to accounts payable factory in Russia. Okay, quick recap. Freight in is an expense, which means that when it occurs, it's going to be a debit transaction to freight in. Freight in can be any source of movement. We could have the erasers come by train. Okay, so your freight in could come by dog sled, just like those yappy mutts that just went upstairs so they'd stop barking on our video. So, factory in Russia sends items. They can send it by train. They can send it by superhero car. Doesn't matter how they send it. Heck, they might get a horse. And the horse is going to transport the erasers all the way over. Doesn't matter. It's all freight because it's transported from Russia all the way to the Sesame Street store. Now, Sesame Street store is going to use up those erasers, and that's the end. No, the Sesame Street store sells erasers. So they just received, by freight in, all the erasers that they're now going to sell. So the factory in Russia, your sign can go away. So Sam, what's it called when a company ships product from a factory or somewhere else into their store? What is that called?
Freight.
Freight. There you go. Repeat after me. Freight. Freight is when something comes from somewhere to our store. Freight is from somewhere to our store. Now, they're selling these erasers. We've got little Bert and Ernie, and they're selling erasers. Like, hey, come buy my erasers. We need to make back that $1,100 in freight and purchases we just spent. So, customer John, your customer John. Customer John is going to come. No, you're not weirdo customer John. You're just normal customer John. Comes over, and you're gonna buy some erasers. But actually, you can't come over because you're too far away. You're actually, way over in Winnipeg. So you pick up the phone. So go ahead. Now call Bert and Ernie.
Hello? I'd like some erasers, please.
I think we could do that. How many erasers do you want?
6 would be good.
Okay, 6 erasers. Okay, and Bert gets his address. He gets all the information. And now he has to get these erasers from the store to customer John. So when the product, inventory, merchandise, erasers, whatever you want to call it, leaves the company, that is delivery. So now they're going to send the 6 erasers by train all the way over. Apparently the erasers are going to fly because they can't go under that thing. They're going to go all the way. Where did I say you were? Winnipeg? Winnipeg. They're going to go all the way to Winnipeg. So this action of the erasers moving from the Sesame Street store in Prince George, British Columbia to Winnipeg, Manitoba is called delivery. Now, Bert and Ernie, they are paying this cost. They had to pay this train to bring it to customer John. So that is a delivery expense. So they paid the train $1,000 to deliver the erasers from Prince George, BC to Winnipeg, Manitoba. And they had to pay the train $1,000. So that's a $1,000 delivery expense. So it was a credit to the bank and a debit to delivery expense. The debit means that that service was received. Bert and Ernie received the service of the delivery happening to the customer. So delivery is always referring to a product leaving the store. So where freight is where something is coming from somewhere else and coming to the store, delivery is always the product leaving the store. So by train, delivers the erasers, they go to Farmer John, and Farmer John's gonna pay $1,100, $1,200, there's a little bit of a profit there, for these erasers. Now, in that transaction, customer John, he paid Bert and Ernie right over the telephone with his credit card. So immediately, $1,200, ka-ching, went into the bank. When a deposit is made to the bank, is it a debit or a credit to the bank? Starts with a D. A debit to the bank means a deposit to the bank. A deposit to the bank means a debit to the bank. So $1,200 was debited to the bank. Now what's the corresponding credit? Well, we have the items and we have the delivery revenue. So customer John, he might have paid $600 for these erasers, plus he might have paid a $600 fee to have them delivered. So the other point with delivery is you can have in a company 2 sets of delivery accounts, because customer John could purchase delivery service from the company. So it's a sale of delivery service, which is a revenue account. So when customer John pays for that delivery service, it is a credit to Sesame Street store because it is a revenue, it is money in, but the service went out. So remember that the revenue is not talking about the cash. The revenue refers to the product or service that leaves the company. The product was the erasers and the service was the delivery of transporting them out. And so the revenue is a credit of $600 to eraser product sales and a credit of $600 to delivery sales. And then that $1,200 in cash went into the company, and so that is a debit to the company. Credit to sales, debit to the company. Okay, so there are 2 transactions happening here because we have that Bert and Ernie had to pay for the train, right? They paid whatever it was, the $1,000 they paid to the train to have it shipped. So they had to pay a delivery expense, but they also received a delivery revenue. This does not go into the same account. You do not see on the books some sort of holding account where the revenue was received and the expense was paid out and that ends up being 0. No, you see on the books that there is whatever it might be, a $1,000 revenue to delivery revenue, a $1,000 expense to delivery expense, depending on which transaction is happening. If it's the transaction happening between the company and its supplier, being the train company, then that is referring to an expense transaction where money is leaving the company and a service is being received by the company. On the flip side, we have the second transaction referring to when the customer is buying something from the company. So they are buying product sales. So they are receiving that. That is leaving the company. The erasers left the company. So it's a credit to sales because these products left the company. And it is a credit to delivery revenue because they are paying for the service of having it delivered. And then on our income statement, when we are looking at our different revenues and their balances for a time period, and we are looking at our expenses and their balances for a time period, we are going to see a line for delivery up in revenue, and we're going to see a line for delivery down in expenses. Now, what value do you think that would be to a company? What do you think? Why do you think a company would want to know how much they're receiving in delivery revenue and how much they're paying in delivery expense?
Well, because otherwise they don't know how much money they're making.
They don't know how much money they're making. Exactly. What if they're undercharging for the delivery revenue? What if they are only receiving $200 for delivery revenue, but they're actually paying out $2,000?
They're losing $1,800.
They're losing $1,800. Now, imagine if the company combined that with freight. So let's say a company actually had $200. Sometimes it's easier to be visual about this. So we have our income statement. So we're going to have income statement. We have delivery, sales, and our revenue. And in our expenses, we have delivery expense, and we also have freight expense. So let's say you're the bookkeeper for this company, and a big part of their sales is delivering products to their customers, and they offer this service. And in this time period for this income statement, for delivery sales, they make $10,000 of delivery sales. Then, in delivery expenses, they end up paying only $2,000. Pretty good. That's an $8,000 profit on delivery expenses. And let's say for freight for that same period, because they bought a bunch of inventory that hasn't sold yet, they had different things coming in they had to pay for up front, and so it's a freight expense right up front. Let's say they had to pay out $15,000 for that incoming product. And you as the bookkeeper, you don't understand the difference between delivery and freight. So instead of recording them in the correct accounts, you combine them. And the customer or the company that you're doing books for is looking at their income statement, and they see that how much did I say I had for delivery expense? Was it 200 or 2,000? It was 2,000. So they see that they have $17,000 of delivery expense because the bookkeeper coded it all to delivery expense because they didn't understand what freight and expense was. So then the business owner looks at that and they're like, I'm losing $7,000 on this delivery service. And they might go and make a management decision to cancel their delivery service based on this financials, based on the work you did. So get it right. You need to know the difference between delivery expense and freight in. It will make a difference for your client. You need to understand. So, recap. Sam, what is delivery expense?
Delivery expense is the amount of money it takes for you to deliver it to another person.
That's right. Now, in accounting, we talk about values. So you just mentioned two values in that sentence. All right, remember our previous teachings. What are the two values? He said money and delivery. So those are two separate things. So there's a delivery value of, say, $1,000. There is a cash value of $1,000. Think of those two separate things, and one is leaving the company, one is coming into the company. So if the company is selling delivery service, that means the delivery service is being given to the company. It's a credit to the company. It's a credit to sales. And they are paying, the customer is paying money for that. So they are paying money to the customer, to the company, and that is a debit to cash Credit to sales, debit to cash. There's always two sides to a transaction. Remember to think in terms of values. Remember to think of it in terms of the category, the word you are using. It is very important that we know that if it's a delivery revenue, that it's a debit to cash because money came in, a service went out. Now, if the company is paying for delivery service, that means the company could pay the horse rider person, whatever. It's a superhero riding a horse and it's delivering the erasers. And that's a delivery. It doesn't matter what mode of transportation happens. The point is, if there is a product that is leaving the store and going to a customer, that is delivery. If there is a product that is coming from, bring the factory back, coming from the factory to the store, that's freight. So let's put our store in the middle here for a second. Put our store in the middle, and we've got our freight from the factory. Hey Sam, could you just come over here for a second and hold up our customer John? So, just right there, that's fine. Okay. So just to show our path of this event, freight in from the factory in Russia to the company that's an expense to freight in because they bought merchandise, inventory, purchases, all words that refer to the same thing, cost of goods sold. So, and then they sold that to customer John, they shipped it by train, so that's a delivery expense that they paid to have that shipped to Farmer John or customer John, and then customer John actually paid for that delivery, so then he paid a fee to the store, so that's a delivery revenue. So in this lesson, we have talked about three main accounts having to do with freight and delivery. Remember what they are?
Delivery fee, freight, and
We talked about how there's two kinds of deliveries. Do you remember what they are?
no.
Okay, so the delivery that the customer pays for is a delivery revenue. It's a delivery sales. The delivery that the company pays for to have something shipped to the customer is delivery expense. You might have one, you might only have that the store is paying the delivery fee and not charging it to the customer. That can happen. You can also have where the customer is paying for so the expense happens and then the customer pays and then there's a revenue and an expense. So in bookkeeping, you might see a delivery revenue and expense happening in correlation, or you might only see delivery expense. The key point is it is referring to a service of moving goods from a store to a customer, where freight is moving goods from a source, a shipper, a supplier, some other country, or it could be a farm in Vanderhoof. It doesn't matter. It is bringing in items from somewhere else to the store. That's freight in. And that's the end of our delivery and freight lesson.